Hi, viewers. This is Matt Leach, and I wanted to welcome you all back to the Cryptocurrency Odyssey show. Now, this year, we're going to be watching the markets for crypto opportunities and all the facets of this amazing invention. We'll still aspire to give you the positive news about cryptocurrency and the troubling news about cryptocurrency. So don't worry. It's been another great year for us. And remember, we don't promote anything here. We just give you the information so you can make an informed decision about cryptocurrency and how it works for you, how it could work for you. Today's show is about pitfalls to avoid and some terms that every crypto aficionado needs to learn and how they can work together. It'll be invigorating and should help you to be aware of some strategies you can develop to profit from this strategy and what it could mean to you. Now, to start off with, there are over 19,000 crypto coins out there, and in such a competitive marketplace, for a crypto to succeed above all the others, to be number one, it has to possess a unique function or significantly improve on an existing technology. Now, a crypto's ability to solve a problem in the world is what defines whether or not it will succeed in the long term. And there's been a lot of failures. I'm sure you've heard of FTX and some other exchanges that have gone under, and they cause quite a commotion when they do that. Now, additionally, when evaluating a cryptocurrency, there are other factors to consider beyond just the price of the coin. And remember, cheaper doesn't always mean better. Some of these include the market cap. You need to know what that is, trade volume, how much the coin is being traded, the coin's past track record. Has it been really volatile or pretty steady? Corporate partners and project backing, who are the money guys is what it is. By making sure a project is well supported by trustworthy and reputable names, you'll save yourself some expensive errors going in on coins that talk a big game but never actually make it off the ground. And I'm sure you've heard a couple of stories or reports about some that have done that. Now, just to take the edge off and not stress anybody out, here's a joke. How many crypto miners does it take to change a light bulb? I'll bet you never thought about this. It takes 1 million, one to change the bulb and the rest to verify what he did. Isn't that pretty funny? I thought it was pretty good, so I thought I'd add it here. Now, this is one that we really have to stress. FOMO, or fear of missing out, is one of the main culprits behind beginners losing money early on in their investment career. Now, fear of missing out is the fear of losing out on a limited time only opportunity and all the profits that come with it. Now, uh, if you wait, you will see other opportunities. There's always something out there that you can invest in. So don't make up your mind too quick. FOMO manifests as selling too early, buying when prices are high because you feel like you're missing out on an astronomical rise, or even just investing in a dubious project that's surrounded by hype and big promises and you haven't done your due diligence. Always do that due diligence before you spend any money. While getting rid of FOMO entirely is difficult, I haven't been able to do it. You can actively combat it by developing a trading strategy and creating a set of rules, which include limits of allowable losses and profits for each coin you invest in. Now, sticking to your game plan when the markets are going crazy is a skill that will serve you well in the long run. It's important to understand that new opportunities in the world of crypto appear every day. So relax and let go of your fear of missing out. Don't worry about that. Now, to navigate the market effectively, investors in the cryptocurrency market must be pretty well versed in these terms. And unless you're staking, never leave your coins on the exchange. We've seen too big to fail exchanges bite the dust lately. And if your coins are in that exchange, it's pretty much bye bye coins. So get a cold wallet and put your cryptos into the cold wallet and keep the cold wallet where only you know where it is. While the crypto market is still relatively new and very unpredictable, understanding these key terms can help investors make informed decisions and potentially profit from their investments. Now, here are some key terms that investors need to understand, uh, and understand them well, to navigate in the world of cryptocurrency. Okay, the first, a decentralized digital ledger that records transactions across a network of computers is called a blockchain. And the blockchain is the technology that underlies most cryptocurrencies. Some don't use a blockchain, but you can pretty much, Bitcoin is a blockchain crypto. The first and most well known cryptocurrency is Bitcoin, of course, and it's designated by the symbol BTC. It was created in 2009 by a group. Nobody's really sure who they were, using the pseudonym Satoshi Nakamoto. And this is where the term Satoshis originated. A Satoshi is a portion of a Bitcoin. Any cryptocurrencies other than Bitcoin are known as altcoins, alternate coins. It's a shortening of that. There are thousands of altcoins in existence, and this is each one has its own unique features and uses, of course. The process by which new Bitcoins and proof of work altcoins are created is called mining. And transactions are verified on the blockchain with the mining. Miners, who are the people behind the computers, they utilize their robust computers to answer complex mathematical questions to get rewarded with newly minted bitcoins slash altcoins for their efforts. And that's how the miners get paid. They get paid in Bitcoin. Proof of stake, and you might see the short version is POS, is a consensus mechanism where blockchain networks reach a consensus on which blocks are added to the chain. So instead of having miners performing the computational work to validate transactions and create new blocks, as in proof of work or POW, in a POS system, validators, often called stakers, are chosen to create new blocks based on the number of coins they hold and are willing to stake as collateral. Now, a software program that stores a user's private keys, which is what something that every investor is going to need, and allows them to send and receive cryptocurrencies, is called a wallet. There's several different types of wallets, including software. Online wallets like Trust Wallet or MetaMask are considered hot wallets because they're online and they're plugged in. So there's lots of wallets. Trust Wallet and MetaMask seem to be among the most popular. There's hardware wallets like the Nano X or the Model T are called cold wallets, and that's where you have no power running through them all the time. Paper wallets, which is a non-custodial cold wallet, means you keep the keys and it isn't connected online. So that's why it's safe. It's not online. If you've got all your crypto in that wallet offline and the exchange decides to go away for whatever reason, you get to keep your crypto because you own it. The rule is if you don't have it, if you don't own it, then they own it. The secret code allowing users to access and control their cryptocurrency holdings is called a private key. Now, losing or revealing a private key can result in losing all associated funds. And these are typically 12 to 24 word phrases, typically 12 or 24 word phrases. A public address that can be used to receive cryptocurrency is called a public key, and it can be shared with others to receive payment. If you use an exchange like Binance, they may give you an address called a BSC wallet, which is typically pretty long and impossible to remember. So you write it down and keep a copy where nobody else can get to it. Now, you can buy an easy to remember wallet name to use instead of any other provided by an exchange. And there's lots of those different exchanges that do that. Some are expensive, but most are running around 50 bucks. So if you think about some outstanding domain names, you could buy and sell them. I guess is how it would work. Self executing contracts with the terms of the agreement written into code are called smart contracts. And smart contracts are often used in the management of blockchain based assets. These contracts have been compared to a legal contract from a vending machine. Probably one of those funny guys. Said that. Now, a financial system constructed with blockchain technology that allows for decentralized trading, lending, and borrowing of crypto assets is called decentralized finance or DeFi. You've probably seen those both in the different websites out there. The fundraising method for a new project or company which issues its own cryptocurrency in exchange for funding is called an initial coin offering or ICO. You're probably familiar with that also. But these are all terms that if you're going to be in the cryptocurrency market, you need to learn what they are and be able to use them and understand them. Now, digital assets representing ownership or proof of ownership in a particular project or organization is known as a token. And tokens can have a lot of different uses, including representing a unit of value, a vote, or access to a particular service. Tokens are often used to pay play to earn players for games, and you'll sometimes see capital P to capital E when they're talking about play to earn. So when the market is such that prices are generally falling and investors are somewhat pessimistic, that's called a bear market. A prolonged cryptocurrency bear market is often called a crypto winter, and you'll probably seeing lots of crypto winter remarks out on the internet right now because we are in one. We are waiting on the crypto spring right now, actually. In a market where prices generally rise and investors are optimistic, it's called a bull market. And a prolonged cryptocurrency bull market is often called a bull run. So that's something that we all hope happens after the crypto winter, right? Now, the rate of change at which the price of a particular asset, such as a cryptocurrency, changes over time is known as its rate of volatility. Cryptocurrency prices are known for their high volatility, making them risky investments. So, again, do your due diligence. Make sure that you've checked out all the different factors that we talked about in the beginning, and you won't make cryptocurrency mistakes, or you'll make them less often. Now, that's about all I have to talk about today. If you want to keep up with the trends of the blockchain industry, of course, you can join communities on Discord, Reddit, and Telegram, or you can tune into Cryptocurrency Odyssey for updates on metaverse platforms. We welcome all suggestions for content. So if you have something you'd like us to review, leave us a comment and we'll consider it. Now, that wraps up our show today. And we hope you enjoyed the new show. And we'll tune in next week when we continue to explore the world of cryptocurrency and how it works for everyone. You can listen to the show again, of course, and download the video or the audio on YouTube at Cryptocurrency Odyssey. And bring a friend when you do that. Bring a lot of friends. And both of you subscribe, leave a comment. I will answer them pretty much, and you'll have something to discuss or argue about on the weekend. So have a great week, and remember, don't take any wooden crypto.